Welcome back to Rekt Radio, the one and only crypto podcast that feels like strapping yourself to a rocket ship filled with fireworks. I'm Sunny, and folks, the fuse is lit.
And I'm Cole. To be clear, it's a rocket ship someone built in their garage, and we're all just hoping it doesn't explode on the launch pad. Spoiler alert, it always explodes.
Explode higher, you mean? Cole, this is what we've been waiting for. The conviction, the momentum, the sheer force of the market is breathtaking. And it's not just us retail believers anymore. The big guns have arrived, and they are not messing around. We just saw over $1.18 billion flow into the Bitcoin spot ETFs in a single day.
Oh, here we go. You see a big number and you get all starry-eyed. That was the second highest inflow day ever. Do you know what that means? It means there was a day with even more frantic, desperate buying. These massive inflow spikes aren't a sign of a healthy, steady market. They are screams of FOMO from Wall Street. It's a panic buy, and panics work in both directions.
But Cole, you're missing the point. This isn't panic, it's a strategic shift. This is the institutional validation we've been talking about for years. This is BlackRock, this is Fidelity, deploying billions of dollars. This is the starting pistol for the real race. They aren't panic buying, they are systematically accumulating because they know what's coming. They're trying to get a position before it's too late.
Wait, let me jump in here. It is absolutely too late. They are building a product to sell to their clients. The ETF is just a fancy wrapper so they can dump Bitcoin onto the balance sheets of their customers at the top of the market. This isn't validation, it's distribution on a scale we've never seen before. They buy it, the price pumps, their clients see the green numbers, they pile in, and then the Wall Street guys take their profits and leave everyone else holding the bag. It's the oldest story in the book.
Exactly. And another thing, it's not just that they're buying, it's what they're buying is doing to the market structure. Think about it. Where are they getting all this Bitcoin? The supply on exchanges is already at rock bottom levels. Every coin the ETFs buy is a coin that gets taken out of circulation, locked away in a vault, and removed from the market. We are witnessing a supply shock in real time.
I swear, Sonny, you could watch a train wreck and praise the structural integrity of the locomotive. This isn't a supply shock, it's a centralization shock. You celebrate that the supply is becoming illiquid, but what that really means is that it's being concentrated in the hands of a few massive entities. You have the ETFs on one hand, and then you have guys like Saylor on the other, who just keep buying and buying relentlessly.
Saylor is a hero, a visionary. He understood the assignment years before anyone else. He is single-handedly putting a floor on the market. Every dip, he's there, buying more. He is not a seller. He is the ultimate diamond hands. That's not a risk, that's a foundation of strength for the entire market. He is creating the scarcity that will drive us to $1 million.
Oh, hang on a second, Sonny. A hero? He's a single point of failure. What happens if his company faces a margin call? What happens if regulators force his hand? If one man's decision to sell can vaporize the entire market, that's not a foundation of strength, that's a ticking time bomb. You're celebrating the fact that one person has that much control. It's the antithesis of what decentralization is supposed to be about.
That's pure FUD, Cole. He's not going to sell. The ETFs aren't going to sell. The demand is relentless and the supply is shrinking. It's Econ 101. And speaking of demand, have you seen the futures market? The open interest is climbing again. That's new money, Cole. New participants are entering the market, opening new positions, and adding fresh capital to the fire. It's a sign of a healthy, expanding, bullish market.
You just said the word fire. That's exactly what it is. And climbing open interest is just a 5-gallon can of gasoline. You say new money, I hear more leverage. Every dollar of new open interest is another over-leveraged gambler betting on the price going up forever. It just stretches the rubber band tighter. It builds the pyre higher so that when the reversal does come, the liquidation cascade will be absolutely catastrophic. This isn't healthy expansion, it's systemic risk building to an unthinkable level.
Volatility is the price you pay for performance, Cole. Of course there's leverage, but the market is absorbing it. It's strong. Let's just look at the raw data. No emotion, no narrative. Let's pull up the technicals on TradingView. I'm looking at it right now. One-day summary, what does it say? Oh, would you look at that? A strong buy. Oscillators? Buy. Moving averages? Strong buy. The charts are telling you everything you need to know. The path of least resistance is up.
Of course it says strong buy. We're at the top of a massive green candle. That's a lagging indicator, Sonny. It's the market's rearview mirror. It's a siren song for suckers. It's designed to lure in the last bit of retail liquidity right at the peak. By the time every single indicator on the chart is screaming buy, you should be looking for the exit. It's a classic contrarian signal. It's a trap.
That's all for this episode of Rekt Radio. The institutions are here, they are buying everything that isn't nailed down, and they are causing a supply crisis that can only resolve in one direction, higher. The data is clear, the trend is your friend. Stay bullish.
My final thought, the market is being driven by a handful of massive players and a rising tide of dangerous leverage. This is not a healthy rally. It's the final euphoric stage of a bubble. The strong buy signal is a warning, not an invitation. Don't be the last one holding the bag when the music stops. You've been listening to Rekt Radio.